Hey everybody, good afternoon. Welcome to 12-Minute Trading. My name's Doc Severson. I am joined by Dave Lukas over here. Today is Monday, the 8th of September. I am back. I haven't been here since July. Seems like a year ago. And, to be honest, the market hasn't moved all that much. But we've got some things to talk about in terms of things are definitely different since July. I think July we had this sort of sense of optimism that the market would go on forever. And now this is why I put the thumbnail up there for today's video. We are climbing the wall of worry. There's a lot to be concerned about. And typically when we've seen something like this, it doesn't quite end up working out the way that most people think. But we're gonna walk through some of the things that are causing this and some of the things that you need to be aware of. And Dave is bursting at the seams to let you know what to do to avoid pain and panic going forward. What's up, Dave?
Well, it's also now I'm going to be out for a little while, and you're going to be flying solo for the next few weeks.
Yeah,
But
there we go.
so there is a number of things here. So I'm going to try to cover them all for you. Doc, you can fill in the gaps too for this. But all right, so let's think about where we're at. We just got the jobs number, 22,000 jobs, I think it was, and we're expecting, I think tomorrow, massive revisions lower, like another 800,000 jobs lower over the last year. So effectively, we haven't had really any job growth. And the thing that I don't think I I don't think government, well, definitely government doesn't realize it or whatever. Markets, I don't think I don't know if the Fed's even really taking into account is that we're in a structural shift in terms of just the economies around the world and business and everything else. And I know this from owning businesses, especially in the software space. I'm building a very rapidly growing one now. And I do not need to hire as many employees because of the technology and the things that are at my disposal to help with the different areas of business. Like, for example, I can implement a HubSpot CRM and automate workflows and everything and don't need live people for that. So I don't need as much support staff. I don't need as much, I don't need as many engineers now to build software because of the fact that we've got AI that can check all the code and even write the snippets of code. So I don't need such a big engineering team. Like all of that is happening. And that's really what I think we're starting to see in the jobs numbers. And over the next 3 or 4 years is really going to become apparent. Companies are still going to do well. The economy, GDP and stuff will probably still do pretty well, but we won't need as many jobs, right? And so where does that leave people? It's a challenge because at the same time, we are not slowing down spending $2 trillion more than we take in every year. And so the inflation side is going to continue to go out with the debt, right? I saw a thing that we've taken in whatever it was several hundred million from tariffs, but yet the trade deficit is higher than it was last year, right? And everybody's like, oh, we're going to take in this money, we're going to pay down the debt with it. Congress is just going to spend that. It's their nature. So we're looking at $2 trillion deficits. That's what drives inflation. That's what causes the issue. And I wrote to my students this weekend, and I even apologize. I mean to sound gloomy about this, but the bottom 80% are going to continue to get left behind because they don't have the ability to truly control the velocity of their money and their income, right? We as investors and traders, we can put our money to work over and over again. For those of you that followed me while Doc was out, did you hit gold? Because I talked about it every week and said when that breakout happens, take it. I probably did 250 trades on gold in the last few weeks selling put spreads on that thing with or 250 contracts, I should say, right? And I'm down to like 10 contracts left at this point from doing that, making the money off that. I have control velocity of money to take advantage of it because I know this, how to do this and stuff, right? But I've also built excess cash to be able to do it with. The bottom 80%, some can make their way out of it to what we do and that sort of thing, but a lot of people have trouble keeping up, and that's why they're falling further and further behind. That's why things are more expensive. That's why now we see things like car delinquencies at all-time highs. Subprime car delinquency loans are at the highest ever, higher than 2008, highest ever. right? We see, a lot of other delinquencies starting to happen, credit card debt piling up, all these things. This is all macro stuff that builds over time, right? And it doesn't affect things like in the immediate nature, but it builds sometimes for years. Like 2008 happened because of building for years of problems. And then it finally came to a head. We're in that kind of spot before, or that we were before. Like, I don't know if it's 2007 or 2005,
So,
right?
Dave, how is
So,
the economy going to continue to grow if the consumers are not going to spend? So, if fewer people have
mhm.
jobs, where's that money kind of is it all going to be government spending?
Well, I mean, $2 trillion thrown into an economy is a lot of money to keep things propped up. And you know as well as I do, everybody out there, that if there is a quote unquote recession, guess what's going to happen? Spending packages, all that stuff to help save the economy. So we're gonna spend $5 trillion again, right? And do the same thing. So that's why I'm saying, like, markets are not the economy, and it's not Main Street, right? Not the average person that's out there trying to, make it go and scrambling to, have enough for groceries at the end of the month. So that's the issue, is that you have this group falling further and further behind, but you have the top 20% doing better and better and better. That's what's propping up everything right now.
But
It's the spending from the top
talked
20%.
you also talked recently, Dave, about a potential like a seismic event which may hit the markets at some point in the next year, which
Yeah, that's what I'm
could
saying. I
be.
don't know if it's 2007 or 2005, but I know that we're building towards it's like a crescendo to where, at some point something's going to break, right?
Hmm.
Whether it's the debt pile up that finally cracks, because the other thing that's happened, and this is why the move in gold is a warning signal. The whole move over the last year plus in gold is a warning signal. A lot of people don't know this, but up until, like, I think it was February of this year, gold was classified as a tier three asset. And what that meant is that things like central banks and everything else, they couldn't, like, it wasn't on par with the dollar or like US bonds and treasuries. As of this year, it is. It's now a tier one asset. So what are you seeing? You're seeing central banks all across the world dump dollars, not buy as many treasuries, all of that stuff, because they're able to have gold on, and it's now equivalent to the same thing. Why wouldn't you think about it? If you've got a country like the US that is continually going into debt the way that we are, and just building up, we're going to be at 40 trillion in debt in no time here, right? So why would you put your money into, like, the dollar loses its value, more of its value every single day. In fact, a dollar today is worth 75 cents from 2015. Think about that. In just 10 years, 25% purchasing power. That's why people are falling further and further behind. So if you're a central bank, why not hold your money in gold? All gold is doing is just, it's not that gold is doing so well, it's that the dollar is rapidly losing its purchasing power and value, and that's showing up in gold. It shows up in the markets too. That's why markets over time go from left to right. That's really just the loss in value of the dollar that you're looking at. And so if I'm a central bank, I'm gonna hold more and more gold. And if I need to exchange it for some dollars and do some things, right? Buy oil is still priced in dollars. You have to use dollars to buy it. Well, then I do that, but I don't have to hold as much anymore. And that's why at this point, our treasury auctions, if you notice, it's all short end of the curve, because number one, the long end of the curve, you don't want to lock in that, expensive rate for longer. But the short end's not changing much. Now, we'll see if the Fed, what they cut, maybe it's 25, maybe it's a 50 basis point cut coming up. But all that's going to do is spur the long end of the curve to get more expensive. And guess what? Your mortgage is based off of 10-year, not what the Fed does. So people that are like, oh, mortgages are going to fall. The only way mortgages are going to fall is if we get into a nasty recession. That's how mortgages are going to fall. And that may come. So you can see there's just like, it's just like a time of just, doesn't it feel like just this year is just like, it's just turmoil all over the place. It's not so much the tariff stuff. It just always feels like you know, there's something, underneath the surface bubbling up. And that's why I said, could be 2005, could be 2007, could be 2004. My point is, at some point, it is going to come to a head, and it's going to have to rectify itself. And the laws of economics typically do that over time. So, so the answer is for me, assets, commodities, things like that that have tangible value. Really focused on those. Markets will continue to go up, but they're going to have wild swings. You're going to have 20% drawdowns, and then the rebounds like we saw. You're going to continue to see that type of stuff in the markets. And so you got to be smart. You got to understand how to read trends and play that. In fact, you're going to pull up the charts in a minute. We may the last point, because I know I've gone on for a while. The typically when the Fed cuts rates, historically, market drops. Market has a big drop, 5, 10, 20% even, when it does it, because it's the Fed signaling that, hey, the economy's not doing as well. This time may be a little bit different in the fact that there's a lot of pressure due to the fact of the debt. The Treasury needs to refinance at cheaper rates, and they're pushing the Fed to drop the price lower, right? Now, the Fed always, old adage, always acts too late and stays too long. They've already stayed too long. That is absolutely for sure. But that's not going to show up till probably next year. And that's why I said next year, I think, fall time is when we could see some carnage. We just haven't seen the shot over the bow yet. What was it? Bear Stearns failed 8 months before, and things like that, right? We haven't seen that stuff yet. So my thing is have a healthy paranoia. Stick to things that no matter what retain value, right? Pick your stocks in the market wisely. Take advantage of the downturn, sell into them, and just be ready though, because at any point, things could come to a head.
Yeah,
So
it's like the musical chairs market once again, all over again. Just a quick, just to add to what Dave's been talking about. This is the ATR. This is the average true range. And so what you'll notice about this average true range is during quiet and trending markets. So like, for example, 2021, the end of 2020 and 2021, average true range was generally about maybe 30 handles a day on the S&P 500. Okay. And then we went through a little bear market in 2022, which, seemed like it was a big deal at the time. And now we look back and say, oh, what a cute little bear market that was. And then we got into 2024, and where's the ATR? It's about the same. It's about 30 handles a day. But what we've seen really since the beginning of the year has been an elevated, to Dave's point, has been elevated ATR. I mean, right now we're at 54 handles. I mean, this is as quiet as the market has been in a long time, and we're still doing 54 handles a day. This is not the same market as what we had in 2021.
and some of that's driven by zero DTE. I think it's like 50 to 60% of all options activity now is zero DTE.
But
So
still, it's still just
I
the
mean,
amount of days
yeah,
where we drive further than the expected move. The market starts off with saying, "Hey, this is where we think plus and minus one standard deviation of price move is going
yeah,
to be." And I don't recall seeing so many days back to back to back to back to back
right.
as lately where the price is closing either above or below one of the expected moves. Normally, most of the
And
time, it stays within a 68% probability.
and with the Fed up next week, here's the thing that I would not be surprised to see this. In fact, as we do this, pull up the charts for the SPX. Pull up the three time frames because I still think like this year we're gonna run through the end of the year. In light of everything I just said, I still think we're gonna run through the end of the year. And we could be setting up based upon where things are for the parabolic tail of this recent move into the fourth quarter here.
And and I agree with you on that because
Yeah.
of there's one thing that I've been watching. It's more than just one thing because it sort of is the bottom line for this. Again, even though the ATR has been relatively big, look at the
Mhm.
volatility, look at the price range. It's collapsing. We had a big move early on this year, and then it's the volatility is absolutely collapsing. The one thing I want to point out to you guys, and this is really important because this happens again and again, no matter what, is that when markets are about to fall, they always they go from being very quiet to all of a sudden they get really noisy and they start to fly around a lot.
Hmm.
And they move, the volatility increases tenfold. It's much bigger. So like examine the beginning of 22 and then compare that versus what we
Hey,
had.
hey, Doc, I don't know if your screen is showing.
Oh, I'm sorry. Here we go. Here we
Right.
go. Sorry about that. Okay, so here's the beginning, the end of 21 and the beginning of 22. Notice how loud and volatile this was, and compare that versus where we had during the summer of 2021. Okay, look at the same thing here. We had the same kind of volatility here,
Mhm.
and it seemed like the market was never going to go down, right? We had all those call spreads run over. Notice what happened here. All of a sudden, it gets really nasty and volatile, very loud, and then it breaks, it releases. Now we got over that. That was not a bear market, even though it feels like it. That was just a correction that happened in the market. But notice where we are again today, quiet and trending. And let's go back. Let's go back to some of the other ones that we've had. Every time things go from being, quiet, and all of a sudden they get really noisy. And we have not gotten to that point yet. Here's the point 20 years ago. So Dave made this reference a few minutes ago where here was 2006, 2007. And then all of a sudden, what happened at the beginning or the middle of 2007? The market got really noisy. It went from being quiet to very noisy here, very big volatility. And that was the signal that said, hey, I'm about to release. And that was an epic one. That was, a generational bear market that we had back in 2008. And so Dave's hypothesis is saying basically that he expects this to maybe we'll have a little shakeout. We've not had anything more than 3.3% since the April dip. And that's not much of anything. So even a 5% pullback would be very normal in something like this. So what Dave is saying, and what I agree with, is that we could see an absolute move to the upside, which nobody will believe because it's going to be accompanied by bad news everywhere. So everywhere you go, it's going to be, hey, employment sucks. AI is taking our jobs. Inflation's not going away. We're fighting with the Fed. What's going on here? And everything, it's going to seem like chaos everywhere, and the market will rip. And
Yep.
we've seen
And the
this
Fed's
so
cut
many
the
times
Fed's
before.
this is like the 70s over again because the Fed is cutting rates into rising inflation. They thought they had it licked in the 70s on the first spike,
Yeah.
right? And then, ultimately it came back with a vengeance. And so, that's all because of spending, guys. That's not because of any other factor.
We
And I
we
think you
pretty
need to
much
understand
we
this.
pretty much had a
Huh?
lost decade, didn't we? It was
Yeah,
like a
pretty
lost
much.
decade from the 70s all the way to the 70s were
Yeah, and
was the worst.
it's all because what is inflation? It's too much money chasing too few goods. What have we seen? What do we see today? Home inventory is at the highest ever. Okay, so the builders aren't building anymore. They're starting to stop the build because they can't sell all the homes, right? People aren't moving from their homes because obviously they're locked in at low rates. I think the average age of a new home buyer is in their 50s.
Yeah, except for
That's
me.
really messed up, right? So like again, seeds are being sown, and we'll see. I mean, there can be like with technology and things we have, there could be something dramatic that really shifts things into higher gear and makes a difference here. But just where the trend's going, it's like the 70s over again, and we could see another decent spike in inflation from the Fed cutting rates. And I don't think the Fed's going to be able to jack rates this time because if they do, then it again impacts the debt. That's the difference from the 70s. We didn't have the debt that we have. And so that's your linchpin to everything. Because think about it. When you cut taxes, everybody's like, "Oh, cut taxes, cutting taxes is inflationary." No, it's not because you don't create any new money. All you're doing is just giving the existing money that exists already made, the same pile. You're just taking a portion and giving it back to the people that earned it, right? Instead of going into the government. The government creates brand new money when they print. So they flood the system with more dollars. That creates inflation. So it's the deficits that we keep piling up that are going to continue to contribute to the inflation. And it's just going to get exacerbated. So
So what do
if
you
you look at,
what do you see
yeah,
as the solution for people to make it through the next year or two with this
like I
type of
said, you've got
framework?
to have velocity of money. You've got to have control over your money. So if you work a job, right, you need to do everything you can to get promoted up and get pay increases and try to keep up with things. Start a side hustle for sure if you haven't already. I'm telling you guys, back to the jobs. We are going to see the first one-person billion-dollar company because of AI in the coming years. You're going to see a company that has $1 billion in revenue that literally is run by one dude or gal. Think about that. $1 billion companies today, tens of thousands of employees, you don't need it. That's the difference structurally that we're going to see.
Only way you can
But
do that today is with the Powerball.
yeah, yeah. But that's the things to be thinking about. And this is not like tomorrow. This is over the next 3 or 4 years that this goes. The only other big linchpin for the U.S. is that right now it's 2031. I expect soon they'll adjust it again to 2030. Social Security is going to be out of money. They've already said they're going to be completely bankrupt. It was 2033. Now it's 2031. It seems like every year it shifts a year closer. So within 3 or 4 years, you're going to hit you know, that deadline, right, for Social Security, where it's going to be completely bankrupt. What do you think we're going to do then? You think we're going to stop spending? I mean,
Get out the
so
printer.
so that's the thing. Keep your money moving, right? The easiest thing to do is just do the wheel. Sell puts on stocks you want to own. If you get them, turn around and sell calls. That's the easiest thing in the world. Even if you got a tiny bit of money, find a stock you like that's, under $20 and do that for now. But you just got to have a way to control that money velocity. It's got to keep up. So, in fact, you were mentioning if you go to the SPX charts, um, you were mentioning the um, just the potential for a dip. And I've been thinking, like, what if we don't get this? What if right now we're starting to see the beginning of the release of the weekly chart? So take a look at the weekly chart and the energy. So weekly chart's gotten all charged back up. If you throw the energy on it, it was at like 60 coming into this week. And look at that thing starting to dip down. And I just, is it because, again, like I said, this may be a little bit different than the previous times the Fed has cut because they're cutting to lower the cost of our debt, right? So does this market just rip into the fourth quarter and use that weekly chart as the just like we just saw with gold, right? That was a weekly chart release.
Yeah,
So do
and
we see that happen?
this has got we've got maybe one more decent swing left on this
Mm-hmm.
SPX chart before it's into the level that we normally don't see it continue going on. So
Right.
it's very unlikely to continue going on. When it hits this level, this is where we go into some serious chop
Mm-hmm.
or pullbacks. Serious chop or
Right.
pullbacks like here,
So
right?
is this, are we looking at the parabolic move? The most of the gains come at the very end of a
At the
bull.
very end of a bull.
Are we looking at what could be that parabolic tail through the end of the year? Santa Claus rally, it's the greatest, move ever where everybody jumps on board and then the rug pull comes in.
Yeah, remember, I mean, probably the greatest one that we ever saw. Remember 16, right? So here's 2016. 2016 was pretty choppy. We had Brexit, we had the election. We get into 2017, and what happens? Rip, rip, rip. No pullbacks, no
Mm-hmm.
pullbacks. And what happened here as we got into the fourth quarter? So everybody said, "Hey, this thing is overbought. This thing is going to
It
pull
went
back. It's going to
nuts.
do
Yeah.
everything." What did it do? Fourth quarter, it goes crazy. What happens when we turn over the calendar? It actually went insane. Now, we paid for
Yep.
that. This is not something you never want
Dearly.
to buy into something like that. We paid for that. That was, range expansion goes to range contraction. But wow, what a move. This was. And so what Dave and I are both kind of coming to the conclusion is based on the character. Dave's looking at this from more of a fundamental perspective. I'm looking at this from more of a technical perspective. And we're both agreeing on the same thing. Like, we may not get any pullbacks here. If we do, they may be shallow. They may be 5%. They're certainly not going to be 10%, unless something unusual happens. But we could rip into the fourth quarter and maybe
It's
beyond.
literally musical chairs until that ends. But I'll tell you what, like just again, if you were with me over the last few weeks where I was just beating that drum beat on the gold chart, just saying be patient, let it release, let it show you the way, take advantage. The last 2 weeks have been awesome for you if you did that. It's the same thing with the SPX chart right now on that weekly chart. Just let it show you the way. Let it break from this consolidation range that it's kind of been in, for the last few weeks. And, it's probably the catalyst will probably be the Fed. Maybe inflation this week. We'll see. But the catalyst will probably be the Fed. And it'll break either way and take advantage. So,
You talked about this one here, the small cap Russell. You
yeah.
talked about this one months ago,
And we're
and
almost there.
look at this. This is the classic inverted head and shoulders that we talked
Mhm.
about, and we said there's a measured move which goes up to here, and we're almost there now. So
Yeah.
this trade's just
Look at
about
the
playing out.
energy. Look at the energy in those charts because the Russell's going to take off with lower rates. All the Russell stock, all those companies are fueled by debt. So the cheaper debt is, the uh, the better that it does. And so you can see, look at that it may be a lot of times the Russell's a canary in a coal mine. Look at what the weekly chart has done. And what has it done? The last 4 weeks, look at that release higher,
Yep.
right? It got charged up ahead of the rest of the market, right? Several weeks ago, it's where the SPX is now, and look at what it's done. So is it the canary in the coal mine again? Right? And it's about halfway through its move at 45 there. So all-time highs, I think we could see that. And that would be just catching up. I mean, the rest of the market, has eclipsed all-time highs a long time ago and kept going, right? So this thing hasn't even come back and hit its previous high yet.
Yeah, let's see. Well, nothing's really cheap anymore. I mean, you could still sell puts on the IWM. To be
Yeah.
honest, I'll tell you what, guys, really quick, just crypto here is maybe your best value play because
Hmm.
you're still seeing ETFs which are in the teens, right? So, well, not the teens, but the lower, well below 100. So you could be selling Ethereum on ETH here
Hmm.
for getting a really like a 2 to 3% return at 27 and a half into October.
Well,
So that's
if you look at EETH even, you want to go out to, if you just want to do like one of what I call my long-term trades, which are 4 to 6 months out, where I'm targeting, yeah, 6 to 10% return on risk. You can go out right now and you can sell out to December or even January if you want to look at January, but December, look at what you can sell at, EETH, sorry, not TA.
I'll tell you what.
You
I've
can look at
I've
EETA though if you want to.
I've gone
Um,
through this, and I am no longer going to trade EETH
you
because of
don't
the
like it,
fact.
huh?
Well, look at the liquidity. When you got something which is 17 by 21,
Yeah, well, you have to be careful which ones you do. But I'm just looking at like even at like a 10 delta on that out to December. So go to like your 10 delta level.
which is 38.
Yeah, do like
So
a 5 wide spread right there
yeah, you
on
could.
a 10 delta.
So 10 delta, 38, 33. See,
Hmm.
that's the problem here, Dave. This is why I won't trade this anymore because, where the hell is the spread here? Where's the actual bid? Which means that it may work favorably for you coming into the trade, but it will absolutely work against you trying to get out of it on an early
Well,
basis. If you compare that versus ETH A, and
yeah,
if we do the same thing, if we do the same thing,
either one you can. I played EETH because it was the first one out there, but
yeah,
ETH you could do the same thing on find the 10 delta.
yeah. So look at this. Look at this one. Look how tight this is. So guys, if you're going to do Ethereum, go for ETH. Stay.
Yeah,
I mean, learn
that's a
from my
good point. And
lesson, and
if you
don't.
do like a just do like a two wide right there real quick. Just do like the 22 by 20 out to December, like you're gonna sell it. And you'll see like, the return at these levels is pretty darn good. I mean, if you do that right, you're gonna get 20, 15 to or 20, yeah, $25.
So
So
25 for a
so
buck 75 risk.
you're getting a great return,
That's
25 bucks on a
that's 14.
$200
That's
risk.
14%.
14%, and you buy it back for 5 cents after time works on it. Now, IBIT, you could do the same thing. You'd be selling below 50 on IBIT, you know. Um, and that's the thing. Like anytime that there's a dump in crypto, like especially when just last week, the um, Bitcoin was down to like under like 104 to 106 level, right? I think hundreds a really good level of support just from a mindset standpoint, right?
Which is
So you're
57.
selling way below there.
Which is 57. So in my mind, what I want to do is I want to continually defend the $57
Yep.
strike price, because that's what I've determined is equivalent to 100,000. But right now, if you did something like that, if you're going to do IBET, let's say we do IBET just as a simple cash secured put, maybe out to like 17 October. And if we do 57, you're going to own, that's well over 1.5% just on that capital. So that works out really nicely. So
Yeah, it's
the
almost
IBIT,
2%.
yeah, the IBIT and ETH, these are both really, really, they become almost like equity market, almost like tech stocks now. And they've got the liquidity, they've got superior option chains. And so if you're complaining that you can't trade against some of these super expensive stocks anymore, you can still do the wheel on
Yeah.
ETH and IBIT. And
I've
they're
heard so
still
many people say,
affordable.
"Man, I wish I could sell puts on Bitcoin, or sell put spreads on Bitcoin." I
Right.
mean, IBIT's how you do it.
IBIT's how you
Um,
do it, man. The IBIT's is not to be beat. So with that, hey, we're running a little long. We appreciate
yeah,
everybody's time, and like we said, Dave is going to be gone, so I'm going to be running solo next week, and we're going to be approaching. We'll see what happens with the CPI and the PPI this week. That will let us know whether or not we're still in an inflationary environment,
yeah,
and with slowing growth. So that could be the stagflation trigger. And then, of course, next week we're going to be seeing. Well, we won't know Monday by that point, but we'll have a pretty good idea of what the Fed's going to do on Wednesday. So we'll
yeah.
talk about it at that point.
Yeah, it's a
So,
good time. I mean, I've been clearing out my trades that are at my exit targets ahead of travel, obviously, and I will say when I travel, typically markets act up. So who the heck knows?
oh yeah, the last time you did
But
that, that certainly was the case.
yeah, so I mean, we'll see what happens. But I'm cleared out. We'll let next Wednesday happen, see what the reaction is. And typically the Wednesday reaction a lot of times isn't the real reaction. So Thursday, Friday, you'll know really, I think. And then you play it from there. But
Yep.
watch that weekly chart of the SPX. Watch which direction that thing really releases to, and that'll give you your telltale sign of where this thing's going.
There we go. Hey everybody, thanks for joining us today. We will see you guys next Monday. Adios. We'll see you guys.